This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Welcome back to the Alternative Investing Advantage podcast. This is the second part of our two-part series with Kirkland Capital, and we'll be covering bridge debt today with Brock Freeman. Really excited to get into that. Don't miss out. Stick around till the end. Today on the download, the big news over the weekend, I think everyone's been hearing about, are bank failures. Now, this is certainly not something that people like to talk about. It's definitely not a pleasant subject, but it definitely is something that needs to be covered. So there were three big bank failures over the weekend, and the two that are most notable are the fact that they are the two largest, or the second and third largest in U.S. history, behind the 2008 financial crisis. These are immensely large banks, but they are relatively insular to the finances of tech startups in the tech industry, which, if you've been listening to the podcast and you've been paying attention to financial markets over the past year and a half to 2 years, you know that the tech sector is being getting absolutely hammered. The two main bank failures over the weekend are Silicon Valley Bank and Signature Bank, which are, again, largely to do in the tech and financial industries. Silicon Valley Bank being a large part of a lot of tech startups where they did their administrative banking, where they did their payroll and other types of things out of. Notable account holders there being the likes of people like Roku, the streaming device giant, had almost $400 million in a single corporate checking account there. Now, the big issue with this is that FDIC coverage only covers deposits up to $250,000. However, the FDIC has invoked a clause allowing them to fully insure all deposits of any depositor there at that bank. So good news for the depositors there, especially for the more institutional holders there that are going to be recouping the funds out of that. And essentially what happened with this bank was an old-fashioned bank run. The underlying investments that the bank had in things like treasury bills becoming less valuable as interest rates rose. So the ability for them to sell their assets to cover the withdrawals that were being made for the bank wasn't able to be sustained, and they had to shutter their doors. And the FDIC taking receivership of that bank on Friday evening, and then as of Sunday afternoon, also announcing the enhanced coverage that the FDIC will be offering to depositors on that front. And then with regard to Signature Bank being the third largest bank failure that the United States has ever seen, that one is a touch bit more complicated insofar as that they were heavily involved in the cryptocurrency space, which, again, if you've ever watched this podcast, again, is a very, very volatile sector. We'll be covering the bank failures in a special edition podcast next week to go more in depth with that. But just suffice it to say, the financial markets have been in a great state of flux over the past few days with the bank failures of Silicon Valley Bank and Signature Bank. Another set of bad news coming out of the tech sector, which again further illustrates the problems that this part of the market has been having, is that Meta, or the parent company of Facebook, has announced an additional round of layoffs, which will be affecting over 10,000 jobs at Meta Facebook. Now, this is in response to another round of layoffs that they had earlier this year, which was another 10,000 jobs. They have announced a plan to hire an additional 5,000 roles, but that's a net 15,000 job loss from just one company in Silicon Valley. So the issues that are kind of being a little bit more systemic in the tech sector are certainly not going away, and we are kind of seeing those firmly implant themselves into this market segment. So if you're looking to invest in the tech sector, now maybe not the best time to do it, but again, if there is blood in the streets, buy property. So maybe now is a good time to get in there and get some more bargain basement deals on different investments, or just be able to buy at the bottom and hopefully be able to ride that up a little bit. But we'd like to round out this segment with a little bit of good news. North American electric vehicle production numbers have increased. So numbers that are coming out of manufacturers such as GM and Tesla have indicated that the consumption and the production rates in the United States are starting to kind of meet in the middle, with the sales numbers and production numbers both rising over last year. We are seeing a rise in new electric vehicle sales as a portion of the whole sector, up from 4.7% in 2021 to a total of 7% in 2022. So definitely some good news for electric vehicle manufacturers and manufacturers of vehicles in general. GM also posting a record year last year. So manufacturing with regard to vehicles, definitely up. Maybe a good place to look if you're looking to move some capital out of the tech sector. This has been The Download. Today on the what is a shelf offering? A shelf offering is a SEC provision that allows for an equity issuer, such as a corporation or anyone that's going to be selling stock on a stock exchange, to register a new issue of securities without having to sell the entire issue at once. This means that a company potentially is allowed to say they are going to sell, let's say, 1 million shares, but only release 300,000 of them at once. This will help to effectively reduce the amount of shock that a market sees and helping to control wild price fluctuations in a particular issue or stock price, while also allowing them not to have to re-register and refile every time they'd like to issue a new block of stock. Companies can do this over a certain amount of time, and that has to be done at a maximum of 3 years. This is a shelf offering, and this has been the What Is. Hi, and welcome to another edition of the Alternative Investing Podcast. This is the other portion of our two-part series with Kirkland Capital Group, focusing first on due diligence, and now something that I'm really interested in because it's part of my career that I've always found people have done, pretty well in it, but it's a little bit understood and maybe has a little bit of a dark cloud over it, is the topic of bridge debt. For most people thinking of financing, whether that's individually on a property or a particular deal or commercial debt. Most people think, hey, like we have one block of debt and that's what we look like. But more often than not, when it comes to any type of investment, there's unforeseen things, there's need for additional capital, there's need for additional debt, which doesn't have to be a bad thing per se, but understanding where it's used, how to understand someone that is not overreaching their leverage capacity, and also how to make money with this stuff. Because from looking at an investment side of saying, okay, well, my investment is taking on bridge debt, but more to the point of saying, hey, let's invest in actually doing this bridge debt, and obviously how that can be applied, to people that aren't overutilizing debt, I think is a really powerful tool, because there's a lot of money to be made in this particular sector. But with that said, there's always, with any type of new thing or more niche markets, there's a lot to look at that maybe isn't as well understood by a lot of people, which goes into why we're doing this as a two-parter, with due diligence being a very core focus of any type of investment, but especially when looking at something that isn't looked at by a lot of people as a viable investment opportunity. So I'm really happy to have Brock Freeman with Kirkland Capital Group on today to talk about some of the joys and risks of real estate bridge debt, and what that is, what it looks like from an investment standpoint, what kind of returns people are seeing on this. So again, Brock, thank you very much for being on with us. Tell us a little bit about yourself, how you kind of came to be in your current position here with Kirkland Capital Group, and we'll go from there.
Sure. Let me start out by saying thanks for hosting me. And this is just kind of my real estate debt. It's been a lot of my career. So it's excited that people are really turning and starting to see this as a great investment vehicle, which I think it is. I mean, I'm personally invested a lot of my net worth in this as well. So kind of putting my money where my mouth is. Let me put off about me a little bit here, and let me skip to the next slide, which is kind of a little bit fun, because as things get a little volatile out there with investment, this came out the other day, and I thought this was pretty good, that investors are turning towards commercial real estate debt to counter near-term uncertainty. So that you're seeing a lot of this in the marketplace, where instead of they're pulling out of public markets, they're pulling a little bit away from equity or being a little more careful there. But you got to put your money somewhere, particularly in this high inflationary period that we have. So bridge debt or real estate debt is a great place to consider. Of course, and we'll dig in to see whether that meets your needs or not as an investor. A little bit about me is I came from a long history of underwriting and auditing loans for multiple different lenders. I have a tech background as well. I know that seems kind of like, wait a second, which one is it? But actually what I did was build lending systems later on after being an underwriter for some different companies. In fact, this is going to date me a little bit, but I actually built the first web-based end-to-end loan underwriting system back in the mid 90s for a mortgage bank at the time. Again, a non-bank lender. So, in my background is finance, but I've taken a turn, in doing a lot of tech and process stuff as well. So that's a little bit about me, and my background. So, moving on, let's kind of dig in what we're going to talk about today, and what I want to queue up. So, I think it's always fun to start out with what's the good stuff. So let's do that. Let's talk about the joys of it, and where it can help, where I think it's a great investment on that side of things. I think there's some tax considerations we need to have as well. But then afterwards, let's give you some things to look at and consider as risks, because there's a lot of different investments opportunities out there in the debt space, and they're not all the same. So let's kind of walk through those. How do you determine what are some things to look at with that? Does that sound like a good plan, Alex?
Fantastic. Let's dig into it.
All right, let's dig in. So let's talk about the joys next. So one of the first things I want to talk about is, in general, debt is lower on the capital stack. Now, depending on where you're familiar with, I know that in some other things like VC, they talk about, oh, well, no, debt's the highest on the capital stack. Therefore, but in the real estate world, we're either upside down or right side up, depending on where you originally came from. But in real estate, we generally talk about debt as lower on the capital stack. That means it's situated, it's foundational. You think of a building going up, that type of thing. So you might have anywhere from 65 or lower up to maybe 80%, on first lien debt. But the nice thing about debt here is that, you've got someone else now taking that more risky top equity percentage. And of course, in here, if you're considering where I want to be for safety wise, where if things are volatile, of course, the price or the value of that asset may change. But the reality is, from a debt perspective, a lot of times you're more insulated from that range of uncertainty, which is a nice place to be, particularly when we're in a more volatile period of time. So, and then preferred equity, or sometimes they call it mezzanine debt, seconds. These are, of course, always going to be a little riskier. When we talk about what bridge debt is, let me talk about that for a second. So bridge debt typically is not necessarily where it is in the capital stack on the debt side. It's more of when it is. So when I talk about when, you're talking about bridge is something that's put in place for a short period of time. It can be anywhere from as low as 1 to 3 months sometimes, up to maybe 3 years on larger deals, where they need a little bit more time. But it's to get you from maybe a purchase where that you're not ready for that long-term, the long-term financing yet, or you're not wanting to get yourself into a prepayment penalty because maybe you're going to do a refinance in a year or two once you've stabilized the property. Or maybe there's a problem with the property. It could be vacancy issues or some deferred maintenance, or maybe you've, for instance, done some things to the property, but you need to get cash out. And sometimes long-term lenders are a little bit more conservative on cash out than bridge lenders. And so you use that bridge to get some cash back out to pay yourself back for the money that you've dumped in the property. And then once that's sort of settled out, and then you can go and do a long-term financing.
Yeah, it makes sense. So with regard to that, where do you kind of see, like, maybe let's say, where did you see, let's say, like the last 3 years, or maybe like, like let's go back a couple years. Let's say like, 2019, 2021. What kind of areas were you seeing people utilize bridge debt then? And then kind of coming into the more current of, let's say, 22 through now, where's kind of the market shifted on where people are needing to use this in their operations of these different types of players that are needing bridge debt?
As I kind of alluded to before, it's anybody who needs speed of execution. So, for instance, a lot of lenders can take long-term lenders, especially banks, or let's say you go do a Fannie Freddie loan. I mean, or an SBA if you're even looking for an owner-occupied, so to say, purchase. You're talking 3 to 6 months sometimes to close. A distressed seller, or maybe you're getting a good deal, they're not going to wait around. So a lot of times your private non-bank lenders are going to be able to move much faster and help take that deal down for that investor. Now, is it going to be more expensive? Absolutely. But the premise here is that they're getting a good deal because maybe it's distressed, or because the seller is in a hurry, they're willing to sell at a lower price, and you've got a buyer who knows that the value's there. They just need to execute quickly.
Sure.
And again, the other reasons are there's a lot of properties out there, and we see this a lot, in our loan flow, where you've had sort of a mom and pop or somebody has held on to that property for decades sometimes. And after a while, they're not really doing the maintenance. They haven't done renovations in years. So there's a lot of upside. There's a lot of meat on the bone, so to say, for an investor to go in there and renovate and do a lot of things in there. So they don't want to have long-term debt yet. And maybe the long-term bank or lender doesn't even want to do it because of that deferred maintenance or because the vacancy factor is too high. That's again where you're going to have a private lender come in and do that bridge debt, and then allow them to exit from that into a long-term a loan once the stuff is done.
Awesome. Great.
One thing I'll mention on here too is, again, this is where, from an investor standpoint, if you're looking for lower risk, this is why here that you're getting that lower risk, because you're not going to be the first to lose if something goes wrong with that property. And I talk about that a little bit on the next slide here with steady valuation, that if you really are looking at that debt position, it's a great way to take a position on something, get fairly steady returns, but you're not necessarily betting like, oh yeah, I know that property is going to go up a bunch. Like, even if that property just stayed the same, or let's say it lost 10 or 15%, you're still going to be in a great position as a first lien debt holder or investor. Now, caveat, of course, and this is my thing on the bottom there, depending on the debt amount versus the value of the asset. So, and we'll talk about that as we dig into the risk a little bit, but that is something to always watch for, is what is the valuation versus the debt.
So I guess I have a question, and this just kind of goes to my understanding and in general of bridge debt. But when you're coming into this, are these bridge loans coming in, after property acquisition? So would there already not be institutional debt associated with the underlying property? So then where is this debt placed on the, on the stack? Is it going to be first position, second position? How is that actually handled with regard to looking specifically at bridge debt for these types of properties?
If you're using it, bridge can be used for purchase, so a purchase money loan, or it can be used as a refinance, a cash out type of deal. So obviously, if it's used for purchase, then of course that bridge debt is in place from the beginning, and then it's going to be taken out by a long-term lender, whether that's agency debt if it's a larger loan, whether it's going to be a bank or credit union if it's smaller, or one of the other non-bank long-term lenders out there. If it's used afterwards, a lot of times there may be maybe they went to another private lender to get a first to begin with, or they've held the loan for a long time and paid it down enough and they need cash out. Or most long-term lenders they don't want to accept let's say, okay, let me just give you a live example here. Let's say you purchase a property today. You go in there and you make a bunch of renovations, and you purchase that property, let's say for $1 million. Okay. And then you did a bunch of renovations. Now it's worth all of a sudden 1.5 because you made those renovations. 6 months later, you fix a bunch of things, whatever, you got it done. Long-term lenders generally are not going to accept this kind of 6-month new valuation at 1.5 million. They're going to want to use that original purchase price valuation of 1 million. So it's not going to be super helpful to go in there and try to refinance to long-term. Again, that's where you go to a private non-bank lender for a bridge loan, is you're saying, hey, who's going to accept my new valuation? Well, we'll go in there, or a private lender like us is going to go in there and do a new valuation ourselves and say, okay, yep, you're right. We see you put the money and work in this. It's now worth 1.5. We'll base our new loan on that new value. So it's called, basically a no season or low seasoning type of loan to give you that money back that maybe you just dumped in there. So the investor can move on and maybe go buy another property and do it again. And then 6 months, 12 months later, when a long-term lender is going to accept that new value and the property as the returns that they're getting out of that, then they can move to long-term debt.
Okay, so just to make sure I'm clear, and this is where kind of the terminology from some of the areas that I deal in differs from this a little bit. When you're talking about bridge debt, you're talking about a whole new debt package coming in to, remove another debt package to be in that first position, not necessarily like, where I deal in sometimes it's like gap or transactional funding where you might come in as a second or an unsecured lender. You're talking about saying, hey, this is still short-term debt, but we're wiping out the underlying, coming in as a first, just with a much more truncated period on the loan, right?
Correct. Okay. Now, that may not be true. That's why I mentioned earlier, like bridge is more about the time period, that they're short term. They're to get you between, a purchase or some period, and when you can put on long-term debt. It's more about timing. That's what bridge debt in real estate is. It's not necessarily where you are in the capital stack. So an important question to consider as an investor in it is to ask whoever you're investing with or whatever fund, do you do seconds? Do you do, are you allowing seconds? Are you always in first position? Because obviously if you're doing a second on top of an existing first, that could be a much more risky position to be in.
Yeah, exactly. And not to say that there aren't strategies for that to make considerable amounts of money, but just like with anything, the return should be commensurate with the additional risk profile that you're taking on. And also, if you're looking for this, varying degrees of risk in this, do you want to take on that additional risk? Is the juice worth the squeeze for you as the investor in that? And again, just kind of from the angle that I come from on, seeing a lot of more of the fix and flip rehab, single family land, small, like single family land development, the terminology is a little bit different. So just in case anyone's coming in from that kind of background, what we're talking about here is a little bit different on the more of the commercial real estate syndication side of doing these types of loans to these people and how that can be a functional investment strategy for you, like, what you have at Kirkland. So again, just at least for my own edification, anyone listening coming from our side, just understand the difference there.
Yeah. Let's we'll dive into it a little bit with the risk part of it, but let's talk about one other bigger joy here in the enhanced return and strong income that we get. It's been, if you're looking at, how do I want to say, if you're looking at wanting to generate income from your investments on a more steady basis, maybe you're in your 50s or 60s and you're thinking about, hey, I need to kind of move from that betting on asset valuation, whether it's stocks, whatever, and going up, and I'm looking more for, hey, I just want to generate steady returns. Either that's just to compound it or just because I need it as income. It's become really difficult to do that in the public markets. You're having to take a considerable risk asset wise to generate that. And that's why you're seeing in the marketplace a lot of people move to investing in private debt funds because they're cash flow focused. You might get that payout on a monthly or quarterly basis. Now I throw up our risk and return and I put our fund on there. And of course, it's going to be different with different risks with each fund, but it does give you kind of an idea about the benefits here, that you can see some pretty outsized returns compared to even the standard fixed income in the public markets, like, there's the REITs, or, even like bonds. Bonds have done horrible the last few years. So and they're risky too, because the pricing goes up and down. I don't have time to go into all that, but and basically this is one reason why we're seeing a lot of investors turn to these private debt funds, is because of the great return risk profile you can get.
Yeah, absolutely. And it's, especially in high degrees of uncertainty, having asset-backed, stable, like contractually obligated return profiles is a really attractive thing for a lot of people. Now, granted, you can say debt and then, you make the correlation to bonds, but, until, Jerome over at the Fed started, going hammer with the rate increases, you don't really start seeing that bond yield start to change at all, especially with the last few years. It's just been getting crushed. So having something backed by more tangible than just the good faith, something backed by tangible assets rather than the good faith of the government is really attractive to a lot of people, and something that we've seen a lot of over the past 20 years at Advanta is a consistent turn. And it's, been indicative of the growth of our business, of people finding more value in this, and, looking at that, even through going through the 6, 7, 8 crash era, still seeing the value of real estate backed or tangible backed assets when it comes to investing, and especially on the debt side. We see that kind of ebb and flow as different markets happen, but it's always been a very strong underpinning of what a lot of our clients look at is the debt side of things, especially, again, once risk profiles change, like you mentioned, people getting older, they're saying, look, what can I get a steady return on that doesn't have kind of to worry about so many extraneous factors? Because at the end of the day, they want to keep these properties. So making sure that those payments are made is a very high priority.
Yeah. Now, one thing, because we kind of mentioned, like, one of the reasons that drives people to look at steady income is, where you're at in your career, life, et cetera. I want to look at the next slide, though, because I want to bring up something that's going to be super surprising, I think, to a lot of you. So if you're not yet hitting your late 40s and 50s and thinking about those things, or longer, let's say you're in your 20s and you're working on your first self-directed IRA on this. Well, here's a reason why steady income or steady returns matter so much. This may be shocking you, because everybody thinks, oh, but over the long term, the stock market, it really returns better than almost everything. And I question, like, is that really true? Because what's not being considered is the volatility here. So let me ask a question. And really, this is rhetorical, of course. So you want $207,000? You want $1,300,000 from a $100,000 return? So if you were looking at 10% annual returns starting at $100,000, but you had the high volatility, this is pretty high, obviously, with stock market. Sometimes it is, sometimes it's not. It's been pretty volatile over the last couple of years here. But the idea here is look at what happens to returns. You think, okay, over a 10% average return over a 30-year period, that should get me a lot of money, right? Well, not necessarily, because even if you went 50% up in that first year and then went down 30%, you've got to start to, your return profile has to become larger and larger to make up for those losses. So that is why volatility, even though it's not something talked about a lot, in the retail investment or among wealth advisors or anything like that, you don't talk about volatility. It's kind of the dirty secret of a lot of public investments, such as stocks, because the volatility will affect your ending returns by a huge amount. And you may be scratching your head sometimes looking at your statement over a number of years going, I don't get it. Why am I not making more money? I thought stocks were supposed to, over time, give me a lot more. But that volatility really affects you. So what would happen if you took an average return that was actually less, but you had steady returns compounded? Let's take a look at the next slide.
Yeah, and to a point to your last slide too. I mean, this is making these numbers are making the basic assumption on one, stable inflation, So,
Mhm.
that 10% return, okay, well, over that 30-year period, did you have a 10% inflationary increase? Well, then did you really make any money?
Yeah.
And
Yeah,
then,
for sure.
it's all these kind of things, yes, these things do return those kind of averages over the long run. And most everyone should be looking at least some type of, longer term investment strategy is going to
Mhm.
pay off and, is typically going
Yep.
to pay off for you. But that's just also something to look at,
Yeah.
and I really do kind of believe in, go to the next slide, but, just in what you're talking about, the ability to compound those returns, reinvestment over a long-term period with low risk profiles is a really powerful tool.
Yeah, I mean, you'll take a look at this and you're going, seriously, that's the difference? And really, yes, am I giving kind of an outsized volatility on the previous one? Yes, I am, but it's more of to sort of, I want to burn it into everybody's brain that volatility matters when you look at your portfolio. And again, I'm not saying don't have any stocks. Not what I'm saying. I've got some stocks in our portfolio. But when you look at that, just make sure that you're considering volatility and the effects on that part of your portfolio versus where you think, yeah, but I'm only getting 9% or an 8% or whatever it is on this low risk thing. It just doesn't pay me enough. Does it really?
Yeah, absolutely. And again, the power of, it's kind of a kitsch term, but the power of compounding returns. It's, if
Yep.
you make 50%, but then lose, a net, it's the slower, steady one that you can compound over time is going to pay off more. Kind of, there was the adage of, would you rather have $1 million today or a penny that doubled every day for 15 days? It's like that. It's like, oh, I want the million. It's like, no, you want that penny.
Yeah. 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 All right. So, we've covered a lot of the joys. Let's talk about a little bit of tax considerations here. Because a lot of debt funds are not tax advantaged in a sense. So interest income tax is usually based on the structure of the funds. So if you're looking at some funds, they're going to be out there, have a REIT or a sub-REIT structure. Those are a little bit better. If you don't, then you're going to want to use some sort of tax advantage usually. Now you can do that a couple ways. Honestly, I think one of the best ways is self-directed IRAs, 401ks. Of course, what Advanta offers, what Alex offers is coming through them, which is an incredibly great way to sort of avoid that taxation on these type of funds. You can also offset with passive losses. So if you've got some pass-through depreciation from real estate equity investments or something like that, of course, that's going to offset that as well. But it's definitely something, you don't want to have the tax horse drive the cart, so to say, but you definitely want to take this into consideration. And that's one nice thing about having a custodian like Advanta to invest in these type of tax that are great at growth, but not necessarily the best tax advantage. Alex, you can probably say more about this than I
Yeah,
can.
absolutely. But one question I have is that when you invest in these types of funds, the underlying income that's derived from them, how is that what is that reported as? Is that going to be a long-term capital gain? Is that ordinary income? How does that normally pass through to an investor? It's going to be what paid out on K1 as interest income on the investment.
There's a few funds out there that pay out on a 1099. I think you're going to find the vast majority of well-run funds, excuse me, are paid out on K1s because you come in as an LP investor into the fund. So you're basically a member. And as a member of that fund, you're going to get a K1. And that K1 is going to show interest income, which is taxed at your normal income tax rates. If you're not, of course, in an IRA.
Yeah, exactly. Just because I know that you're in what you can only offset $3,000 per year of ordinary income with investment losses. I think so. You'd have to claim that from other type of like asset depreciation
Yes.
losses. Again, I always have to disclaim I'm not a tax advisor. I'm just a nerd for taxes. So trust but verify, check with that kind of stuff. So but
definitely see your CPA on this kind of thing.
I would say see a good CPA. Don't go to H&R Block and Walmart. Go to someone that's been doing it for a while. I just had a fantastic podcast with a guy, Micah Frame out of Tennessee, who specializes in cryptocurrency and taxation. And this was kind of a big topic of the fact that wash sales are not illegal in cryptocurrency investments. So people can generate kind of loss farming in cryptocurrency right now, which I found was interesting.
Yeah.
But not to digress too much into that subject, but yeah, doing this kind of stuff through IRAs is really interesting, especially if you're invested strictly in something that is originating debt. One thing that I do like to clear up is that IRAs specifically have kind of a wonky tax issue when you invest into an asset that has underlying commercial debt. So if you're in an equity position and then the fund has taken on debt to acquire assets, they're not originating the debt. You have an issue with what's called UDFI, or unweighted debt finance income tax, which, not to get, I can get really far into the weeds. I talk for hours on this stuff, but suffice it to say, it kind of muddies the water with the great tax advantage nature of doing retirement plan investing. But if you are investing in the debt, the origination, like, your IRA is going out and making the loan, or you're investing in someone that is making those loans, you don't have to worry about that. So you get the security of the underlying real estate, you get those returns, but don't have to worry about that really kind of, bespoke tax that's associated with that. Now, with a 401k, you don't have to worry about it at all, so long as that the acquisition debt is for real estate. Again, whole other kind of topic to get into, but that's a big thing important for people to understand when they hear debt and they hear IRAs. Sometimes people are like, oh, well, I saw this thing, I don't want to do that. Not necessarily the case. It's having debt associated with the acquisition of something that's the issue for an IRA, not investing in someone that is originating debt. That's the issue.
Right. That's right. Yeah, and that's where when you, and again, I think once you get to a certain point in life, and you're got, and you have more than just, let's say, a W-2 job. You've got now some investments that are worth $1 million or more. That's really the time you should consider getting a professional, good quality CPA who knows this stuff, can really help you with your taxes. I've seen, especially for me as an underwriter, I look at tax returns all the time for our borrowers, and we really, it's sort of the automatic red flag when we see someone with self-prepared tax returns, because almost always we see someone that's made a mistake. And don't think that using TurboTax is going to help you not do that mistake. It's just not made for those kind of sophisticated tax returns. It's made for, oh, I'm Joe Blow with my W-2 and I've got, a little bit of E-Trade, and that's about it. Once you get beyond that, go get yourself a good tax preparer CPA. That's just my best advice.
Yeah, an ounce of prevention is worth it. An ounce of prevention is a big pound of cure in that one.
Yeah. And they're probably going to save you more money than they're going to cost you, honestly, with tax, with helping you get better on your taxes and tax advantaged.
For sure.
So we could, honestly, there's enough here that you could have a whole nother deep dive on where to sit, what investment in IRA, 401k versus your non-retirement money. I mean, that we can get totally in the weeds with that, but I don't think we have time today. So, all right, let's now kind of dive into the risks of looking at debt funds, because there's certainly some risks, and almost every investment, unless you're talking about investing in a CD at your local bank. So there's going to be some risks. So let's take a look at what those are. So first of all, let me just I'm going to sort of go over a few things here that are more debt focused, but the reality here is that there's way too much to cover due diligence, and we have a separate webinar that actually done by my partner and also the chief investment officer for Kirkland Capital, Chris Carsley, who does a much deeper dive into due diligence, and that's you would help yourself by going and listening to that and watching that as well. But I'm going to touch on a few debt focused ones. So to touch on a few, and again, this is not an exhaustive list here, but these are some questions you want to ask before investing in a debt fund. Are they on the administrative side? Are they administered by a third-party administrator? Or no, I'm doing all my own stuff. Kind of going back to getting your own CPA sometimes. You shouldn't be having people that are doing all their own stuff. It's just too easy to make mistakes. You got nobody looking over their shoulder. So you want to see that they have a third-party administrator who's accepted in the industry. On the audit side, is their debt fund audited? And you can ask. People do ask us sometimes to see, hey, can we see your audited returns or your audited financial statements? Absolutely, we'll send it to you. That's the whole reason we do that, is we want people to feel confident that we've got not only a third-party administrator, but is the firm or is the investment fund audited? Is there dual controls on money? Can someone just go in there and go, hey, I'm gonna, send $1 million to my Cayman account and take off? Well, if you got dual controls where two people have to authorize things, you got a lot less chance for anything to go wrong there. Legal, make sure, I know they're boring. They can run anywhere from 60 to 80, 100 pages for a PPM, that private placement memorandum. But I beg you, read those. That has all the fees in there. That has all the risks in there. It makes sure that down the road, you don't go, what? You did what? I thought you could only do debt. You're going and doing equity. You're going and gambling with my money. Well, I didn't know that. Oh, yeah. You didn't read the PPM? That said we could do that. Read your PPMs. Make sure what that fund manager is allowed to do and allowed to charge you. And also, read the operating. Usually those are much smaller, but read your PPMs. And then the really, some of the things you're looking at in the fees and expenses are in that PPM is what they and you as the investor being rewarded for additional risk. I've looked at a lot of PPMs in this business in the debt side. You've got PPMs or you've got places where I've even seen it that a manager is rewarding themselves for taking extra risk. So if I go make a loan, a risky loan to somebody and I charge them 18%, am I passing that additional money that we're making on the interest rate to the investors? Or am I taking that spread and I'm giving you 9%? Oh, I'm giving all my investors 9%, but if I can make a really high interest rate loan on a risky thing, I'm going to take that 18% and I'm going to pocket that 9% as a manager. Well, basically, you're now rewarding the fund manager for the risk that you took. Well, I'm not quite sure that's fair. I'm not saying there's anything illegal or wrong with it, because there's not. But unfortunately, that's one reason you need to read those PPMs. Look and see, is your manager aligned with you as an investor on the risk side?
Yeah, absolutely. And there's even, and it's things that it kind of gets to that kind of micro level, but even things, one thing to look at is that, what does the return structure look like? Is it return on capital or is it return of capital? Because you can get washed out of an investment and lose an entire great tax benefit if you're getting returns of capital instead of return on your capital and the underlying equity in the investment. Not to say that, again, there aren't places for that, but just understand, like, small words of and on can have a huge impact. And especially with markets getting tight, good people are going to do good business, but it also opens up for questionable people to start making bad decisions. So reading these things, and I'd encourage people, even if, these things are not the easiest thing to get through. I've had to read through a lot of them, and even still, I'm like, what is going on here? Pay an attorney for an hour of their time, or maybe pay them a little extra to show you how to read this stuff. Again, the ounce of prevention being worth a lot of cure in this scenario. There are people out there that can help you with these things. I wouldn't maybe necessarily go to your investment provider to ask them how to read their PPM, because they're going to highlight a lot of stuff. But go to a qualified third party. Again, going back to having a good CPA, having good counsel around you that can help navigate these things that are, again, alternatives, not mainstream. It's going to really help you out in the long run.
Yeah. So that was the operational bit, some of the highlights of risk there. Let's look next at sort of the investment side. So, are these pooled or individual loans? There's debt providers out there that basically sell you a piece of an individual loan, particularly when they get large. Nothing wrong with that. It's just a different risk profile, because that means that you're making an investment in one loan. Or is it a pooled fund where your money is distributed across all the loans in the portfolio? So, that's to ask you about diversification. And actually a lot of these are you can consider whether they're diversified or not, but geography, is it just concentrated in one state? Oh, this is a California. I'm only picking on California because there's a lot of California debt funds out there that's only focused in California. Well, okay. Then you need to consider, do I want to be concentrated in California? What are the legal or even political risks of that. Right now, we just saw one of the courts in California come down and say, "Oh, hey, if you go go into default on a loan or you didn't pay on time, you're only allowed to charge default interest on the actual payment that's late, not on the entire amount." Oh, wow. You just gave permission to everybody just to basically ignore payment. I mean, all you did was make it really difficult to uh, cause someone to decide that, hey, I better pay this because it's going to get too painful, a debtor. So, I mean, there's some craziness going on out there. Pay attention to it. Being spread probably among multiple geographies is could be a much better thing, because then you're not stuck if one thing goes wrong in a particular geography or state. Asset types. So, are you concentrating in one? Office used to be the darling of Class A debt funds. And even on and right now we're seeing a lot of doom and gloom headlines, I'd say right now. Oh, CRE is crashing. And then you start to read the article and realize, oh, they're only talking about office. So what's wrong with office? That could be another whole conversation. I think a lot of it right now with all the remote work and everything, we're not done seeing bloodletting in that. Or are you hotel, or are you multifamily? I mean, there's a lot of different asset types. Each have their strengths and weaknesses over time, or at a particular time in the economy, or at a particular time in where we are in the economic cycle. Single family, that's fix and flip. That's a whole different asset type as well, with its own issues and pros and cons, so to say. Another thing to look at, and a question to ask, or looking at PPM, is the manager using leverage to boost returns? So, you wonder, like, okay, how is this manager, or how is this debt fund returning, let's say 13 or 14%, but they're only charging 8% on a loan? Well, they're using leverage. They're for every dollar of money that they lend out to specifically, they're actually borrowing money from a third-party source, a bank or someone providing that line of credit, in order to boost that. Now, there's nothing wrong with that. Okay, it's not a right or wrong here. It's about where you are in the risk. Leverage can move both ways. It can be great in boosting returns, but if something goes wrong, that can crash you real fast if you have high leverage on that debt fund.
Yeah, I never even would have noticed. I don't think I've ever really run into kind of the debt booster issue, at least nothing that I've ever read through. Is that something a little bit more nuanced or new, or is it like a really specific use case? Like, when would you ever really see that?
Actually, it's very, very common. If you go start reading the PPMs of most debt funds, particularly a lot of the fix and flip ones, they are using massive amounts of leverage, sometimes 1-to-1. So if let's say they've got a debt fund of $50 million, they're going and borrowing another 50 million. The challenge here is that when things go south on a loan, you could be left with nothing, because they have to, by covenants, pay that debt provider, the leverage provider first before any of their investors.
Yeah, absolutely. That's just probably due to the fact that, most of the stuff that I read through is it's more like fintech, commercial, like acquisition, real estate, stuff like that. I can't really think of the last time I've read a debt fund. I mean, probably, if I come to think about it, I probably only read like one or two. So, yeah, it's really interesting that it's a really specific use case in that market. And just maybe like a quick blurb, like why is it more common in the debt fund space?
Well, it's the way that you're able to provide outsized returns to investors. So that's how you can go out, particularly in a low interest rate environment, and offer a 6, 7, 8% and compete in the marketplace, especially when you start talking about larger loans where the competition is really heavy in those. You $10 million bridge loan. Well, I've got to offer it, maybe previous to this year, you would have had to offer it at maybe 4% or 5% for a bridge. But you're going to have to offer a lot more to your investors to get them to invest in that fund. So you put leverage on that, and now you're paying out maybe 8 or 9% to your investors. That's where that leverage comes in.
Gotcha.
And again, I'm not saying leverage is bad or wrong. Sometimes it's about, amount. Like even we as a debt fund, we don't have leverage right now. We were considering that we'll probably add a bit, maybe up to 30 to 40%. And more of it's just to be efficient. So if we don't have quite enough money to cover, a new loan comes in, this allows us to go grab a little bit of that leverage, make that loan. And so we don't have cash drag on the fund. So
Makes sense.
but because we're using a fairly low amount, it's not necessarily something to boost our returns by a huge amount, because we're very cognizant for us of being low risk.
No, that's interesting. I always feel bad when I don't learn something new when I do these podcasts. So it's always great to not only bring new information to people, but for myself to be better educated. So great. Moving on.
Yeah, and one of the last let's move on to asset evaluation. So this is probably one of the most important things. I mean, not that any of the others are important, but we need to really consider how assets are valued. And really, this is the importance of V and the LTV there. How is that value in the loan to value assessed? Is it as is value? So when someone says, "Oh yeah, we're only at 60% loan to values on these things," okay, how are you determining that value? Oh, we take the after repair value. Okay, well, that's not the same as is current value. After repair value is a guess. It might be an educated guess, but it's basically taking it, and these are used along a lot of fix and flips, a lot of fix and flip debt funds. This is what they use, is they'll say, okay, you're buying a house for $100,000. You're going to put $50,000 into it, and then we think it's going to be worth $250,000. Okay, so your after repair value is $250,000, but you bought it for $100,000. What's the as-is value? The as-is value right now is $100,000. But you're going out and making $150,000 loan on this place. Well, and then you're saying, oh, well, no, 150,000 divided by 250. I don't know. I can't do math in my head, but I mean, oh yeah, we're only at 60. We're a low LTV on this. Well, are you really? You're basing it on the fact that you're going to go do these repairs, and you hope that 6 months, 9 months down the road, when you go to sell that, the market holds up, and you actually will sell that at 250. Now, just not long ago, a year ago, it was a safe bet, I guess, because you were seeing this rise. House prices were going up like crazy, and so in rising environments of rising house prices, this tends to work really well, because it's, hey, I'm making this bet, and I'm gonna have this future value of 250. I know we're gonna sell it, but the markets turn really, really fast. And all of a sudden now you're left holding debt at 150. Oh, but wait a second, I can't sell it for 250 anymore. I can only sell it for 150. Well, that's where, again, ask how is valuation done? And then the second thing is, who assesses the value? So let's take a look at that. There's a lot of ways to assess value. We've seen, and let's look at the common types of assessment. Next slide, please. There's a lot of ways to look at assessments here. So a common one out there that was very popular, sometimes with fix and flips, etc., was BPOs, or broker price opinions. And I've got a little picture of a belly button there, because this is our opinion on broker price opinions. They're like belly buttons. Everybody's got one. I don't think they're worth much at all. It's basically a broker price opinion is having a real estate agent go out and drive by the property, maybe even go in the property, and take a few minutes, run a few comps, and here's what you got. There's no deep due diligence. There's no they look all different. There's nobody really looking over their shoulder to provide these things. So
yeah,
they're generally not acceptable.
Yeah, too dependent on the human factor. I mean, it's you get someone that's been a commercial real estate broker for 40 years that is, as honest as the weather, and they can probably give you a great one. They can probably almost match up to a full appraisal. But you also get someone that gives you the same thing that's, just got their brokerage license, been doing this for 6 years, and probably one of the best real estate markets we've ever seen. Mm-hmm. And yeah, you're going to get something wildly different.
Yep. Then there's hybrid. We use a lot of these, where you might have an agent go out and take pictures and do the boots on the ground, take a bunch of pictures, draw out, look at a bunch of stuff. Then what they do is they actually submit it back to an underwriter and an actual appraiser, a licensed appraiser, who sits at the desk, takes those photos, looks up the comps, and does all the work then to pull together that sort of appraisal. These are more and more common. A lot of it is because, particularly in the commercial side, we have such a huge shortage of appraisers. So your average appraiser out there is, I think, in their 60s on the commercial side. So that's where we're seeing the rise of these hybrid. We like the hybrid. We think they're good. Of course, it pays to ask more questions, to a debt fund. Tell me a little bit about how this hybrid works. Is it actual appraiser that actually looks at this, or is it just maybe a BPO plus someone doing a second check? It just pays to ask those questions. There's automated valuation models out there as well. Think Zillow. There's a bunch of competing models as well that work out there. We've seen this in some other debt funds where they're just simply running AVMs on, particularly on the housing market. You don't see it as much on the commercial side just because there's a lot more difference in the commercial side. It's harder to do an AVM. And then, of course, the sort of the gold standard still is a full appraisal. But on a commercial appraisal, these start at $3,000 to $4,000 or $5,000. So it's a very expensive. It can take sometimes 4 to 6 weeks to get one. So a lot of debt funds have gone to, hybrid, that kind of thing, in order to try to speed things up when speed of execution is, or especially on the smaller loans, like, asking someone who's doing a $500,000 loan for a mixed use property, in somewhere in the middle of America, asking them to pay $5,000 for a full appraisal. It's a tough nut to swallow. So
Yeah,
that's where we go with the hybrid, which are usually less than $1,000. But ask about what they use and who they use for assessments.
yeah, absolutely. Because you got to understand, hopefully you're putting out, capital that is, correctly attributable to that. That's a great example you gave of the, the after repair. What's the actual value of it right now? Because you're essentially you're gambling at that point. Any investment is a gamble to an extent. You are taking a calculated risk and putting your capital in somewhere that you think will grow. But again, especially like we've seen, some of the common threads of issues with real estate market crashes has been valuation based. That's how we got into so much trouble with income verification and inflated valuations on the 2008. That was part of it. There's a bunch of other things that went on with that, but you saw that happen in the 90s. You had to see it happen in the 80s. You see it happen over and over again, where it's a key component is the valuations on these assets, getting people into trouble when it comes to over leverage or bad leveraging.
Yep. One reason we like the commercial side a little more is valuation tends to be a bit more, well, not a bit more. Valuations on commercial properties tend to be much more steady day in and day out. There's exceptions. Right now we're seeing huge write-downs in the office. So I'm not saying it doesn't happen, but generally you have far more steady valuations. And a lot of that is because it's income driven. Whereas in the housing market, it's a very emotional driven thing. Oh, I feel this neighborhood's great now. It's up and coming. And I like this house. You're not talking about it's income driven, whereas commercial valuations, a lot of them are income driven.
Yeah, it's the cash flow drive. It's the cash flow driver versus like the retail sale aspect of single family. The velocity of trade in that area it's much higher when you look at just again the velocity of money in the sales side for single family versus the relatively stable sales. Relatively, again, apples to oranges. But it being income driven, of saying, okay, the valuation is much more pegged not on what the sale of this property would do, but what are the rent rolls look like? What are my expense ratios to it? What's my deferred maintenance?
Yes.
How much depreciation do I have on this kind of thing? So it's a completely different model to look at. And it's important for people to understand that when it comes to, making the jump from single family or making the jump from single family debt, especially let's call it single family debt. If you're a debt investor, a loan, an investor, loan originator, and single family, you can use a lot of those skills like you have of looking at valuations and worthiness of people to lend money to, or especially if you're invested into a fund. But again, it's a completely different animal when it comes to a lot of these different things that you're looking at. Use those skills, but build on them.
Yep. All right. That sort of wraps it up for risks. Next slide. I'm not going to spend much, but we are a debt fund ourselves. That's why my background with this as well. Feel free to reach out if you want ask more questions. I'm happy to answer whatever difficult question. I doubt I'm going to see anything new, but I'd love to be surprised after 3 years of doing our own debt fund here if I've got a new question, but happy to answer questions from the audience later on. Just send it over. And then you can get a hold of us, next slide please, at kirklandcapitalgroup.com. And we do have a newsletter where we talk about a lot of due diligence stuff and educational stuff.
Yeah, great.
We really appreciate it, Alex.
Yeah, absolutely. It's the first time we've done a 2-part series with anyone, but I really am happy with, I think, the way this is going to turn out. We always love bringing new, perspectives on investing and, good information. The deep dive that Chris and I did on, depending on which order you're listening to these two, the deep dive is fantastic on due diligence. I've talked about due diligence in the past, but I'm kind of nerdy on that stuff, and that, I like to read these kind of things. I like to read PPMs and tax law and stuff like that. So, getting a really, a very, very seasoned financial professional like Chris going through due diligence for an extended period of time was awesome. And then talking about bridge debt and how that equates here with Brock was also very informative, awesome content. So I'm really appreciative that y'all both took, the better parts of your days to kind of sit down, do this with us, bring some good information to people on, different alternatives and ways of looking at things. So again, really appreciate you being on with us, Brock. If anyone has any questions for them, he gave out his contact information, and we'll certainly put that out as well. So again, thanks everyone for joining us for another edition of the Alternative Investing Advantage podcast. My name is Alex Perny. Thanks for joining us.
Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.